Welcome to PTA. We understand that managing your accounts can be complex, but we're here to make it straightforward and stress-free.
Hello and welcome to this really important explainer from ProTax Accountant. We need to talk about a major shift that's coming to the UK's venture capital world. The government's announced some big changes to investment schemes, and they're set to roll out in 2026. So, if you're a founder or an investor, you've got to get your head around what's on the horizon.
Look, if you're a founder trying to raise capital, or maybe you're an investor looking for those tax-efficient opportunities, what we're about to cover is absolutely crucial. The government is basically redrawing the map for startup and scale-up funding, and the changes coming into effect from April 2026 are something you need to get ahead of, starting right now.
So, what's really at the heart of all this? Well, the government is overhauling two of the UK's most vital investment schemes. That's the Enterprise Investment Scheme, or EIS, and Venture Capital Trusts, VCTs. Now, this isn't just a minor tweak, it's a major strategic shift, and it's designed to push more funding towards high-growth businesses. But as we're about to see, this creates both winners and losers. Right. Get your calendar out and mark this date down, the 6th of April, 2026. From that day, a whole new set of rules kicks in. For companies, it's going to affect how much you can raise. For investors, it changes the tax relief you can claim. Honestly, understanding these rules today is essential for your financial planning tomorrow. Okay, let's start with the good news, because there's actually plenty of it. The government's goal here is pretty clear. They want to help more UK scale-ups get the capital they need to really grow. And to do that, they've raised the funding limits by quite a bit. Let's take a look at what that actually means. So, up until now, here's how it worked. For your company to qualify for either EIS or VCT funding, it's total gross assets, and that's the value of everything the company owns before you take away any debts, had to be no more than £15 million right before the investment. You can imagine, for a lot of fast-growing companies, they'd hit that ceiling way too quickly.
Well, from April 2026, that limit doubles to £30 million. This is a huge deal. It means that larger, more established, and you could say potentially less risky scale-ups can now qualify. It just opens up a whole new tier of companies to investors who couldn't access them before through these schemes.
And these changes are right across the board. The gross assets limit, that doubles. The annual amount a company can raise, that doubles too, from $5 million to $10 million. And the lifetime limit, you guessed it, doubled, from $12 million up to $24 million. And it gets even better for what are called knowledge-intensive companies, or KICs. Think of firms with really high R&D spending. Their lifetime limit jumps to a massive £40 million. The big takeaway here is that the government is giving high-growth businesses a much longer funding runway. Okay, so we've seen all the good news, the expansion. Now we need to talk about the rebalancing. Because while the government is given with one hand, it's definitely taken away with the other. And that's specifically when it comes to venture capital trusts.
And here it is. This is the single biggest cut in these reforms. The upfront income tax relief you can claim on a new VCT investment is being slashed by a third, dropping from 30% all the way down to 20%. Now, what's really critical here is that the 30% income tax relief for EIS investments, that stays exactly the same. So you can see this creates a really clear split between the two schemes.
Let's make this real for a second. Let's say you invest £100,000 into a VCT today. Right now, you can cut your income tax bill by £30,000. Great. After April 2026, that exact same investment will only save you £20,000. That's a £10,000 difference, and it fundamentally changes the whole risk-reward calculation for anyone looking at VCTs.
So, why would they make this change? Well, the official reasoning is all about fairness and balance. The government points out that VCTs have this one really unique advantage. Any dividends they pay out are completely tax-free. EIS investments just don't offer that. So they argue that by cutting the upfront VCT relief, they're just leveling the playing field between the two.
And this all brings us to the big question for every investor out there. In this new world, which scheme makes more sense? Is it EIS or is it VCT? You know, the answer really depends entirely on your own personal financial goals and what your appetite for risk is.
Before we dive into the relief percentages, it's so important that we're all on the same page about the basic structure here. An EIS investment is you taking a direct stake in one single early-stage company. It's high risk, but it's also got high potential reward. A VCT, on the other hand, is a fund. You buy shares in the VCT itself, which is a publicly listed company, and it invests your money across a whole portfolio of startups. It's basically a way to spread your risk.
Right, this is the crucial slide. After April 2026, EIS has a clear win on upfront income tax relief. It's 30% versus just 20% for VCTs. EIS also gives you that valuable capital gains tax deferral and loss relief, which really helps to soften the blow if an investment doesn't work out. VCTs don't have those. But VCTs do hang on to two key advantages: those unique tax-free dividends and, of course, the benefit of being a diversified fund. And just look at the holding periods too. You only need to hold an EIS investment for 3 years versus 5 years for VCTs to keep all those tax benefits.
So, knowing all of that, what should you actually do? Well, whether you're a founder or an investor, the time between now and April 2026 is a really critical window for some serious strategic planning. We'd recommend a pretty simple 3-step review. First, for businesses, reevaluate your funding roadmap. With these new higher limits, could you raise a bigger round and give yourself a longer runway? Second, confirm your eligibility. Are you eligible now, or will you be soon under that new £30 million asset test? And third, for both founders and investors, now is absolutely the time to get some professional advice to help you navigate all this complexity.
And here's a little professional tip from us at Pro Tax Accountant. Getting these valuable tax reliefs for your investors isn't automatic. It takes meticulous record keeping. Having proper documentation of your funding history and your share issuances is absolutely essential to keep HMRC happy and to make sure your investors get the benefits they're expecting. You'd be surprised how many companies run into issues here when their tax position gets reviewed.
And amongst all of this change, there's a really important piece of good news that gives us some stability. The government has extended the legal lifetime, the sunset clause, for both of these schemes all the way to 2035. This is a massive signal that EIS and VCTs are a core part of the UK's long-term economic strategy. It means you can build your business and your investment plans around them with real confidence.
Wow, we've covered a lot of ground there. So let's just quickly summarize the key points and talk about what your next move should be. Okay, here are the 5 key takeaways. First, the big headline for investors. VCT relief is dropping to 20%, while EIS relief is holding strong at 30%. That really shifts the balance. Second, for businesses, the opportunity is huge. Your fundraising limits have basically doubled. Third, you can plan for the long term, because both schemes are now secure until at least 2035. And finally, and maybe most importantly, because of all these changes, doing a strategic review isn't optional anymore. It's absolutely essential.
Okay, and of course, we have to go through the important disclaimer. This explainer is just for informational purposes. It is not financial, investment, or tax advice. Any tax reliefs always depend on your own individual circumstances, and of course, the law can change. Remember, EIS and VCT investments are high risk, and you could lose all of your capital. It is so important that you consult a qualified professional before making any decisions.
If you'd like some expert, personalized advice on how to navigate these changes for your business or for your investment portfolio, the team here at Pro Tax Accountant is ready to help. Just give us a call on 07985 689912, or you can drop us an email at info@protaxaccountant.co.uk.
So, we'll leave you with this final question to think about. What do these changes really mean for your financial future? For more expert insights on tax and business strategy, please make sure you subscribe to the Pro Tax Accountant channel. Thanks so much for watching.